everyone, welcome back to With Secure. In today's video, we're breaking down one of the most frequently asked questions in personal finance. Debt mutual funds versus fixed deposits. Which one should you choose? We'll cover everything from returns, risks, and liquidity to tax implications, specifically for the Indian financial market. So if you're trying to decide where to park your hard-earned money, this video is for you. Let's dive right in. First things first, what exactly are debt mutual funds and fixed deposits? Debt mutual funds invest in fixed income instruments like government securities, corporate bonds, and treasury bills. Returns are market linked and vary depending on interest rates and market conditions. Fixed deposits or FDs are offered by banks and NBFCs where you invest a lump sum for a fixed tenure at a guaranteed interest rate. Returns are predetermined. Essentially, debt mutual funds give you a chance to earn market-linked returns while fixed deposits guarantee a fixed, secure return. Now let's compare these two options across some important factors. When it comes to returns, debt mutual funds offer market-linked returns. This means the performance of the bonds or securities the fund holds will determine how much you earn. These returns can be higher or lower depending on interest rates and market movements. Historically, debt mutual funds can provide better returns than FDs, especially over the long term. On the other hand, with fixed deposits, you know exactly what you'll get at the end of the tenure. The interest rate is fixed and there's no worry about market volatility. But FDs generally offer lower returns compared to debt funds, especially after factoring in taxes and inflation. Let's talk about risk. With FDs, there's virtually no risk. Your principal is safe, and in India, deposits up to Rs 5 lakh are insured by DICGC, making it a solid option for risk-averse investors. However, debt mutual funds carry some risk, though much lower than equity mutual funds. You'll have to deal with interest rate risk and credit risk. If the interest rates rise, bond prices fall, affecting your fund's value. Also, if a bond insurer defaults, there's a chance of loss. Though funds often invest in high-quality debt to minimize this risk. Now, let's talk about liquidity. Debt mutual funds are generally very liquid. You can redeem your money almost any time, though some funds may charge an exit load if you withdraw too soon. In contrast, fixed deposits are locked in for a specific period, and if you break your FD early, you may face penalties or reduced interest. Now, this is where things get really interesting. Taxation. Let's break it down for you. Debt mutual funds are treated differently based on how long you hold them. Short-term capital gains, or STCG, if you redeem your investment within 3 years, the gains are added to your total income and taxed according to your income slab. Long-term capital gains, or LTCG, if held for more than 3 years, LTCG is taxed at 20% with indexation benefits. This means you can adjust your cost price for inflation, which can significantly reduce your taxable gains. With indexation, your taxable amount decreases, which means you pay less tax on your returns over time. Fixed deposits, on the other hand, are straightforward, but not tax-friendly. The interest earned is taxed as per your income tax slab rate every year. If you're in the highest tax bracket, that could be 30% or more. No indexation benefits here, which means the full interest amount is taxed, reducing your effective returns, especially if inflation is high. For example, if you're in the 30% tax bracket, an FD offering 6% interest effectively gives you around 4.2% after tax. Compare that to a debt fund with long-term capital gains and indexation, you could see significantly better post-tax returns. So which one should you choose? Here's a quick recap. Debt mutual funds are ideal if you want higher potential returns and are okay with a bit of risk. You're looking for tax-efficient long-term investments. You need liquidity without worrying about penalties. Fixed deposits are ideal if you want guaranteed returns and zero risk. You're in a low income tax bracket and don't want market exposure. You prefer a fixed tenure and don't need access to the funds before maturity. Ultimately, it comes down to your risk tolerance, financial goals, and tax situation. If you're looking to grow your wealth with some tax efficiency over the long term, debt mutual funds are worth considering. But if you prefer stability and guaranteed returns, fixed deposits are a reliable option. Both debt mutual funds and fixed deposits have their pros and cons. The right choice depends on your financial goals, how much risk you're willing to take. Remember, always consult a financial advisor to see what fits best for your personal situation. And don't forget, if you found this video helpful, give it a thumbs up and hit that subscribe button for more personal finance tips. Drop your comments below if you have any questions about debt mutual funds or fixed deposits, and I'll be happy to answer them. Thank you for watching, and I'll see you in the next video. Till then, happy and safe investing.